So we're diving deep into options trading today,
Right.
but like not the basic stuff. We're going way past that.
Yeah, we're going to assume you already kind of get the basics.
Exactly. So today's all about those juicy strategies, the risks you really got to watch out for. So you can really get this whole options thing.
Yeah, so let's just remind ourselves, what are options again?
Okay, so options. They're like rain checks, but for stocks.
Yeah.
But you don't have to buy or sell.
At a certain price.
Right, the strike price, and by a certain time.
Exactly, and you've got your two main types, calls and puts.
Calls and puts.
A call option lets you buy the stock at that price, the strike price. And a put, that gives you the right to sell.
Okay.
Well, there's the covered call. It's pretty common. You sell a call option, but for a stock you already own.
So you already have the stock. Interesting.
You actually make money from that premium just for selling the option.
But, like, what's the catch?
Well, you limit how much you can make. Let's say the stock price explodes.
Right.
You only profit up to that strike price.
Now, what about when you want to, like, protect yourself? If the stock goes down.
You're talking about the protective put? You buy a put option for a stock you own.
Like insurance.
Exactly. If the stock price drops, the put option, it goes up in value.
And you don't lose as much. I wish I'd known about that. There's this one stock I had.
Oh, yeah.
Just plummeted. It would have been great to have that protection. Now for something a bit more risky, I guess. The straddle.
The straddle. Now you're talking. You're basically betting on a big price swing. Either way.
Up or down.
Doesn't matter. You buy both a call and a put option, same strike price.
So no matter what, you're kind of covered. But buying both options, that's got to be expensive.
It can be.
So more to think about.
Always.
We've covered some strategies, but I've heard of a few more, like the iron condor and the calendar spread.
Oh, yeah. Those are getting a little more advanced.
So not for beginners.
Well, they can be tricky. The iron condor, you're selling both a call and a put spread. You're betting the market will stay pretty steady.
Steady.
Yeah, and it uses something called time decay to your advantage.
Time decay.
So we've touched on risks, but I think we need to really unpack that. We know premiums cost money.
Right.
But what other risks should people be aware of?
Leverage, that's a big one. Options, they let you control a lot of stock with just a little bit of money, so you can make more.
Exactly. But that also means you can lose more, and fast. Imagine a lever, it can help you lift something heavy. But if you use it wrong, you can get hurt.
Options are like a lever for stocks.
Kinda, yeah.
Okay, that makes sense. What about time decay? You mentioned that before. What's that all about?
Time decay, it's like the closer an option gets to expiring, the less it's worth, like a melting ice cube.
So you got to make your move before it completely melts.
Exactly. You're hoping that stock price moves the way you want it to, fast.
Time is literally money with options.
And that's a good way to put it. Before you jump in, do your research, practice with like a simulator, figure out how much risk you can actually handle.
Good advice.
Options can be really rewarding, but you gotta be smart about it.
Exactly. That's what we wanted to show you today. All the things you should be thinking about with options.
Keep learning. There's always more to discover.
And as always, trade responsibly.